Welcome to the Week in Review, the show that brings you up to date on the week that was. Here are the top stories. Infosys posts robust earnings and forecasts steady growth. Draft telecom policy pushes for overhaul of old rules. And inflation remains high while industrial production stays sluggish. We begin with Infosys, which kicked off the earnings season for India's IT industry on a promising note. The company reported robust growth all around in the second quarter and issued a guidance that was better than some had feared. Profit in the 3 months to September grew 10.8% sequentially to 1,906 crores, and revenue gained 8.2% to nearly 8,100. Margins also went up by 1.9% to just over 28. CEO S.D. Shibulal said the company had added 45 new clients during the quarter, with 17 of them coming from key growth areas for Infosys. Meanwhile, the Infosys guidance for the fiscal year was cut down but didn't alarm investors. The dollar revenue growth forecast was brought down to a range of 17.1 to 19.1%. The earlier forecast was for 18 to 20% growth. Infosys has cited currency fluctuations as the main reason for the reduction. In other news, the government unveiled a new draft telecom policy on Monday, and it appears to be a policy tuned to India's increasingly mature market for cellular services. Telecom Minister Kapil Sibal announced proposals meant to streamline regulations for operators and benefit customers. For starters, the draft policy reiterates that spectrum for cell phones will be available at market prices. It also proposes separating license applications from spectrum. The draft rules allow telecom firms to share and trade spectrum with each other. They also allow operators to exit the industry altogether. On the other hand, service providers will also be asked to provide free roaming across India, a move that could eat into margins. The draft policy is now open for feedback. Once comments flow in, changes will be made and a fresh draft sent to the Telecom Commission. Moving on, foreign currency convertible bonds may soon become less attractive for Indian companies. Mint has learnt the Reserve Bank plans to create stricter rules for FCCBs. It could go about this in either of two ways. One, it could require companies to set up a reserve for redemptions of FCCBs. Two, it might place caps on exposure to the instruments. FCCBs act like conventional bonds as long as they're still with bondholders. But they can also be converted into equity once the company's stock reaches an agreed upon price. Some $7 billion worth of FCCBs are due to mature in 2013. But RBI is worried some firms may not be able to redeem them. Staying with corporate news, Oil India Limited is looking for advisors to help it scout for assets overseas. The company plans to list 8 outfits that will advise it on securing oil fields in Africa. Advisors will include Goldman Sachs, Royal Bank of Canada, and Royal Bank of Scotland. OIL is currently focusing on West African countries like Gabon and Nigeria. In a related development, the Union Cabinet has eased the way for state-run firms to acquire raw material assets abroad. In a decision on Thursday, it granted them more autonomy to make such buys. So-called Navratna companies will be able to spend up to 3,000 crores without asking the government. And Maharatna category companies will have a new upper limit of 5,000 crores. Until the Cabinet decision, the maximum for both was just 1,000 crores. The move is expected to help PSUs compete more effectively with private firms abroad. Switching to the economy, new figures show India's industrial output remains stuck at low levels. The index of industrial production grew just 4.1% in August. The revised figure for July is 3.8%. And there was no let-up on the bad news. On Friday, the government released figures that show wholesale inflation has remained over 9% for 10 months in a row. The wholesale price index for September stood at 9.72%. That's only a tad lower than the August figure of 9.78. Higher prices of fuel and power were the main culprits that kept inflation stubbornly high in September. And with no sign of an easing, the Reserve Bank is more likely to increase rates once again when it meets on the 25th of this month, even though industrial output remains low. And here are some stories in brief. Auto industry body SIAM has cut down projections for car sales growth this fiscal to just 2 to 4%. The earlier forecast was for 10 to 12% growth. Rising fuel and interest costs are the main factors keeping car buyers away. The CBI has registered a criminal case against the Maran brothers over the Aircel-Maxis deal. Former Telecom Minister Dayanidhi Maran and Sun TV owner Kalanidhi Maran are under scrutiny. The CBI is investigating whether Aircel's owners were forced into selling to Malaysia's Maxis. The Bombay High Court has ordered drug company Wockhardt to pay bondholders their dues by August of next year. The company will have to pay FCCB holders a total of around 417 crores. The money will be in addition to 115 crores Wockhardt has already paid up. And finally, struggling carrier Air India could scrap its first-class service entirely. The airline is conducting a study on changing seat configurations on board to increase profitability. Demand for first-class seats has fallen in recent times as companies try to save costs. And that's all we have for you. Thanks for watching.